Hello! Today I'm going to talk to you about ways of improving your net rental return on your buy-to-let property. You may have found in recent years that overheads, running costs have been higher than perhaps previously. You may have suffered one or two void periods between lettings, and you may find that your P&L account, your income and expenditure on your buy-to-let property has been a little less rewarding at the bottom of the page. So here are 4 suggestions that I can make which may well enable you to improve your rental yield. The first one is, have you recently reviewed the rate of interest that you are paying on your buy-to-let mortgage? Some people perhaps have owned a buy-to-let property for up to 20 years, and they may have started off on a very competitive fixed rate. That may have reverted to a tracker rate, which is obviously variable, and you may have found that the percentage interest rate has crept up in recent years. There are some very keen rates about at the moment. We came across one at 1.69%, which was a fixed rate available now for 2 years, which would probably enable you to save quite a lot of money in interest payments. So have a look at your current mortgage, maybe speak to your broker if you have one, go straight to your lender otherwise and say, this is who I am, this is the rate I'm paying, what else have you got that would be worth my while? If there is a product fee chargeable by the lender, you could ask them to add that to the outstanding balance, so that's not a cash flow expense for you at this moment. So that's one way in which you can not only save money, but probably make yourself feel better about George Osborne and his rather vicious attack on buy-to-let landlords when he brought in his reduction in the amount of mortgage interest tax relief, which is slowly chipping away at the relief that we have been enjoying as buy-to-let landlords. Secondly, have you any other assets that you could liquidate and release the capital from, which would enable you to pay off perhaps a few thousand or tens of thousands of the outstanding balance of your buy-to-let mortgage? For example, you may have indulged in some investment in wine, and you may have a case or 2 or more of wine sitting in a vault somewhere waiting for the market to recover and for the price of the value rather of the wine to improve. Now if that is sitting there doing nothing, perhaps you could use the proceeds of the sale of that, even if you have to take a small loss on how much you paid for it, and then apply that capital to reducing your buy-to-let mortgage and thereby saving on your monthly interest payments. Another example of how to reduce your mortgage payments would be to look at the number of properties you have. Perhaps you have, let's say, 4 properties, each with its own buy-to-let mortgage. Consider selling one of those, paying off the mortgage on that one, and using the capital, the equity that you've released from that mortgage to pay off some or all of the outstanding amounts that you owe on your other 3 properties. Now if you're approaching retirement age or are getting to the point where the lenders are going to want you to repay your mortgages on your buy-to-lets, then this would be a very good thing to do, because if you can clear your mortgages gradually over the next few years, then you'll be a lot better off in terms of the rental income without that outgoing on the mortgage interest every month by the time you reach retirement age or beyond. You'll find, as a matter of interest, most mortgage lenders want you to repay your buy-to-let mortgages by the age of 75. So bear this in mind as you go through your retirement financial planning, as this could be one way to solve the problem of how to raise the funds to pay your buy-to-let mortgages. So in retirement you might have 2 or 3 properties instead of 4, but you've cleared all your mortgages and you've got real rental income to benefit from when you reach that age when you've retired and perhaps got into your 70s. The fourth way in which you can improve your property and your rental return is to think about any refurbishment work that would be worthwhile. When did you last spend any money on the interior of your property? Is it proving a little bit more difficult to let each time it becomes available? Do you have a longer void period? Do you get feedback from your letting agent or from your applicants, the prospective tenants, that they don't like it because it isn't quite up to date, or it doesn't have this, or it doesn't have that? All these pointers would indicate that your property isn't quite as cutting edge or as attractive to the incoming tenants that you're hoping to find as it used to be. It's not really unreasonable to spend money on an asset that you may have owned for 20 years, which has suffered fair wear and tear and is looking a little bit out of date. I mean, you wouldn't be running your car, for example, without having it serviced. If the garage tells you need new tyres or new brake pads, new exhaust, you wouldn't say, well, just leave it as it is. You would maintain it. So as well as the essentials within your apartment or your house, your property to rent, think about the overall appeal and whether you are keeping it up to speed and up to date. If you manage your property directly, make an appointment to go along and have a look around when your tenant has given you notice that he's leaving in a month or two, and be very selective about what you think needs to be upgraded. Your agent will have a view on this as well, but don't throw money at it without due consideration. We had a case recently where a property had been occupied by the same tenants for 7 years, and it had been owned by our client, the landlord, for at least 15 years. We went in and we carried out a fairly major refurbishment, and when we put the property back on the books for reletting, we achieved 63% more in rent compared to the previous rent level, and it let immediately. The tenant went straight in and said, I'll have it. So by having less void periods, shorter void periods, having a more attractive property which will appeal more often when you relet it, and having spent that money, you will have enhanced the appeal of the property not only to your next tenant, but also when you come to sell it, it will be that much more up to date and therefore achieve a higher sales price for you. One final benefit to refurbishment is that providing you're only claiming like for like, in other words, you've put a new washing machine in for an old washing machine because there was one there already, or you put a new bed in for an old bed, that is for tax purposes a replacement. It is not an improvement. So anything that is being replaced, the cost of that is allowable for tax against your rental income. And the vast majority of refurbishment work is generally replacing old for new. And therefore all of that expenditure is going to be allowable against your rental income. It's only when you improve, and the classic example is replacing single glazing for double glazing, would you only get 50% of the cost of that work as an allowance against your rental income. So at least you'll be getting one back over George Osborne, despite the fact that he's moved on, because you will be getting tax relief on all of those type of expenses. And if you don't soak up those tax reliefs in year one, you'll be able to carry them forward and therefore set them off against next year's rental income. And that way you probably won't pay very much tax for some time to come on your rental income, because it will be soaked up by the capital expenditure, providing it is like for like and it's replacement of existing items or features within your property. So I hope that's been useful. Thanks for listening. I'll be back soon on another topic. Bye for now.